India's financial institutions will continue to face a difficult operating environment amidst the economic slowdown and weak funding conditions. That's the word coming in from Fitch Ratings. It expects India's FY20 GDP growth to slow to 4.6%, led by liquidity squeeze from NBFCs. Let's discuss this in great detail with Saswata Guha, Director of Financial Investors at Fitch Ratings India. Saswata, thanks very much for taking out the time. So some of these points that mentioned in your report is something that we are seeing on ground. But the anticipation of things improving is also being factored in. Do you think it's a little too early to see a meaningful change with regards to liquidity? Because we've been constantly talking about how there is excess liquidity in the system.
Hi, good morning. Yeah, well, these are all pertinent questions, and this commentary that comes out essentially is a summary of the questions that investors are asking, and they're not very different from what you're asking me. Coming to your specific question, we think that at least the immediate near term certainly looks a little bearish in light of the broader economic slowdown, and quite clearly it has sort of been overwhelming since the credit squeeze that the NBFI sector saw, and the second order economic impact of that on a couple of the other sectors. Under normal circumstances, we would have probably expected banks to start recovering from their legacy problem assets, and to an extent they are sort of, you can see that happening. But our worry is that in light of this current slowdown, it is quite possible that the banking sector, which is currently still, I think their overall balance sheet and P&Ls are still quite fragile. And our worry is that the economic slowdown may create new asset quality problems before they have actually completely dealt with their legacy issues, which for us basically means that prolonged weak performance from the banking sector.
So in light of that, on the basis of your analysis, this year in particular, what kind of credit growth are you expecting from the NBFC segment in particular? And you think that from the bank standpoint, that gap can be filled, or that's going to be a little bit of a tall order?
Yes. So when we started out, I think our expectation for this year was, in terms of loan growth, was around 12%. We have since sort of marked it down, and now we're looking at sort of high single digits. If you look at the loan growth for the sector as of 9 months of this financial year, it is hovering somewhere in the range of 8 to 9%. So clearly, there is a certain risk aversion that one is seeing from the banking sector. But also, I think there has been a demand squeeze as well in light of what's been happening in the broader economy. And I think both factors combined, we believe that the overall credit growth for this financial year is not going to be or is unlikely to be in the double digits. See, in terms of banks' ability, yes, while it is true that in the last couple of years and most recently, I think the government has pumped in a fair amount of capital into its banks, but the fact remains that a lot of the capital has come in at a stage where many of the banks themselves were sort of facing with regulatory capital ratios which were in fact at the border or below the regulatory capital requirement. So a lot of the capital that actually came in from the government has gone into sort of bridging that gap. What we are seeing now is banks essentially trying to hold on to whatever capital they have, because clearly they are also trying to sort of negotiate through this current climate, and that's one of the reasons why we believe that while some of them may have the capacity to lend, but I think they're all sort of veering on the side of caution and probably not lending out as much as perhaps the government may have been expected them to do.
Saswata, the other bit is what your note says, that it's not just banks which have a direct exposure, but also exposed to the second tier, the second order effect that you mentioned about. Now my question is, a lot of people envisage at the end of December that there'll be a third wave of credit credit defaults that could happen. We haven't seen signs of that, and the RBI seem a lot more amenable to be supporting this space. Is that a tailwind of sorts, while the broader view still remains one fraught with risks?
So yeah, I mean, when that wave might hit again is sort of $1 million question, but I do agree with you that clearly the authorities have been incrementally more supportive in terms of trying to avert a kind of contagion kind of a scenario. But having said that, as credit analysts, we remain quite bearish in terms of some of the forbearances that have come forth, because the way we see it is that the sectoral issues at the moment are issues that perhaps where policy actions would have made more sense instead of pushing the onus onto the bank's weak balance sheets. But having said that, what is important to note is that if you look at the last guideline from the central bank, it is not very clear whether these forbearances are available to the non-banks, and while we believe that there is a high degree of probability of that actually being extended to the non-banking companies. But the thing is that if you look at banks' direct exposures to some of these tricky sectors, whether you look at MSMEs or real estate, though that level has not increased materially in the last maybe 3 to 4 years. But having said that, banks do have a lot of indirect exposure to these sectors through the NBFIs, which have lent quite aggressively to both MSMEs by way of LAPs and even direct loans, and as well as the real estate sector. So I think there is a risk. Now, because of the forbearance, it is quite possible that some of that risk may not necessarily sort of reflect in terms of the numbers, but unless the macro scenario improves materially, what it will do is basically push the problem out rather than actually solving it.
Okay, got that. Saswata, it was great talking to you and getting your thoughts on the report. Appreciate it.